Quite a year on Wall Street. Since the start of 2009, the Dow is up 20%. The S&P 500 gained 25%. And the NASDAQ has added 45%. The numbers are even more impressive if you look at the multi-year lows reached on March 9th. So what's behind the recovery? What's ahead in 2010? We want to ask Steve Forbes, President and CEO of Forbes Incorporated and co-author of How Capitalism Will Save Us. Steve, good morning. Thanks
for coming. Good to be with you. Thank you.
Really appreciate it. What is the most important driving factor in pushing the stock market back to a level of recovery?
The most important happened in March when those lows were reached, and Congress did something that didn't get much notice, which was change of bank regulation and how banks value their capital. Before, it looked like the whole system was going to go down. Most of the losses were book losses, not actual cash losses. When that was changed in March and April and everyone realized the world's not coming to an end, the market started to recover. And so we've had a very good recovery, especially considering what happened in the year before. However, before we get too giddy with the champagne, we have to put it in context. When you take especially the lousy value of the dollar, most other marts around the world have done better than us. But hey, take the nice gains.
Let's take what we'll get, right? On the other hand, we're still looking at 10+% unemployment. You see this rise in the stock market, and there's a sense of relief for people with 401ks and everything else, and retirement investments. But on the other hand, there's not a recovery on Main Street. Is this a precursor, or will we ever see better times again in so much of the rest of the economy?
I think we will. We'll get a recovery next year. It's not going to be the kind of a real bounce back you normally get after the kind of fall we had late last year and early this year. But again, you're going to take what you want. You're going to take what you can get. But the three things to watch out for. One is the dollar. The weak dollar is a real dampener on business investment. We've got to get rid of that weak dollar. Number two, big issue on taxes. Taxes, the tax cuts of 2003 expire at the end of the year. Big debate coming up on that. And then there's an issue out of our immediate hands, and that is the Middle East. Israel, Iran. That's probably going to come to a climax this year.
Because it certainly can drive up oil prices and all kinds of other things.
It can have all sorts of consequences.
That have negative consequences. Let's go back to the economy itself, because the economy that collapsed was based 70% on consumer spending. That's not a sustainable economic model. Is there something else out there that can replace what didn't work before?
Well, the consumer side went on a binge, in part because the Federal Reserve's weak dollar policy meant it was printing too much money, which distorted economic activity. We had a binge in housing instead of a more normal activities. Now, if the Fed gets a stable dollar again, which is quite capable of doing, we've done it before, this is not something new, you'll start to see more traditional business investment, expanding existing businesses. Inventories are still very low. Starting new businesses, there's a lot of innovation waiting to come, just as we had in the early 90s.
All right. So happy days are almost here again.
Just make a few positive changes. Maybe Washington taking a vacation year long. That'll do some good too.
Steve Forbes, thank you so much.
Thank you.